Hello, we're excited to welcome you all to today's expert roundtable discussing fundraising in a turbulent capital market. This is the 8th event in our quarterly expert roundtable series. Following our earlier sessions on behavioral health, DE&I, go-to-market strategies, building world-class teams, and others. Today, we're very fortunate to be joined by 10 outstanding entrepreneurs, senior lenders, and investors. First, we will kick off by discussing external capital market and funding environment with Pamela Aldsworth, Managing Director at JP Morgan, Michael Hanewich, Managing Director at Silicon Valley Bank, Mara Huntington, Managing Group Director at Signature Bank, Brian Khanna, SVP at Comerica Bank. Then we will shift to a conversation focusing on what leading investors are looking for during this turbulent time with TJ Carella, Managing Director and Head of Healthcare at Warburg Pincus, Jim Tananbaum, Founder and CEO at Foresite Capital, Rob Vorhoff, Managing Director and Global Head of Healthcare Group at General Atlantic. Lastly, we will discuss what it's like running a fundraising process in the past year with Ankit Gupta, founder and CEO at Bicycle Health, Stephen Gutentag, co-founder and CEO at 30 Madison, Kuldeep Singh Rajput, founder and CEO at Bioformus. We'll structure the hour into 3 roughly 18 minutes fireside chats, starting with our senior lender friends. So without further ado, I'll hand it off to Michael Greeley to kick us off. Michael, off to you.
Hey, thank you, Ian, very much. This is obviously a super complicated time in both the equity and the debt capital markets. And we could think of no better participants than the 4 venture lenders that I have the privilege to both know and partner with. As I'm welcoming them all to the stage, I looked at some of our own data. We have roughly 35 portfolio companies, and only about 20% of our companies have actually availed themselves of venture debt. Now, in many of the board meetings over the last 6 to 9 months, all of us are talking about it. So I wanted to first, as we go through the discussion, let you each introduce yourself, and I'll just go around the horn, but then talk a little bit about the current state of affairs. How do you think about our sector and some of the risks that we're all staring at? But maybe, Pamela, I'll let you go first.
Thanks, Michael. So I'm Pamela Aldsworth with JP Morgan. I head up the Venture Capital Relationship Group, which works with all the venture funds in the nation. And so we do both tech and life science and healthcare. And as far as the markets, I think it's a very interesting time right now. We're seeing a lot of volatility, whether it be in our space or in the greater macro environment. I think our space right now, you're hearing a lot, but you're not seeing a lot. A lot of companies still have a bunch of cash. There's been mild layoffs and maybe some big layoffs, but not, I don't think we've seen it pervasive in our industry. And the other thing I would say very quickly is a lot of companies were flushed with cash. It's been a really good fundraising environment. So companies right now, most have between 12 and 18 months of cash. So I think we have a little bit of a kicking the can down the road kind of scenario going on right now, for when companies really have to think about change and what's going to go on.
Yeah. I'm going to try and do this alphabetically. Michael, introduction and maybe comments on what you're seeing in the market.
Yeah, absolutely. Thanks, Michael. Michael Hanewich. I work with the healthcare VCs in the US and Europe. I've been with SVB 23 and a half years. I'm the young guy here. I also work with most of the portfolio company CEOs. I actually used to work with Pamela way back in the day. We're seeing a lot, actually, and there's no exact formula here. To generalize, having gone through 2000, 2001, having gone through 2008, 2009, I've been through a couple of these things, and some of my long-term venture friends that have gone through these times have been very good about over-reserving for their companies. Most have been very quick to not necessarily put the brakes on growth, but to make sure that they are flush with cash or have a sight line to cash. And so we are seeing a lot of companies. We have not seen a down round close yet, we have seen, or in the process of many rounds where they are not necessarily rounds at convertible notes, and they're converting at the next round. And most have varying discounts to 5% a month to 10% a month with a cap. One has a cap of 50%, one has a cap of 42%, one has a cap of 30%. I could go on and on. And we were involved in one that was going to be a down round. The CEO initially didn't want to take it. I talked to the VC. I was like, you're going to tell them to take that, aren't you? And he said, of course, because it's only going to be worse 6 months from now. That round ended up not closing. But it's a very interesting time. I think you will see down rounds, but haven't seen one officially yet.
I want to circle back to specific terms in a moment, but Mara, just would love a brief introduction and your observations. You're out on the West Coast, so maybe you have a slightly different perspective.
Yeah, Mara Huntington with Signature Bank. Nice to see everybody. We launched our group in March of 2019 with a group of 24 veteran venture bankers. So we've been at it with Signature for 3.5 years now, but have been doing this for much longer than that. Yeah, observations. I would agree with Pamela and Michael. I think, a lot of our portfolio companies and companies that we see have 12 plus months of cash, so don't necessarily need to raise right now. I think existing investors are putting money in for their winners, right? But I think next year is going to be telling, because those runways are only going to last so long and you can only cut burn so much, right? So I think next year we're going to see some pressure on the valuations where companies just have not grown into them.
Yeah. And Brian, over to you.
Thanks, Michael. Yeah, Brian Kane, I lead Comerica Bank's technology and life sciences practice, or essentially our venture and growth banking practice here in Boston. Obviously, given our seat in Boston, we've got a unique lens into both the healthcare technology space, but also biotech. We cover everything sector and stage-wise, from early seed stage all the way through exit, so essentially public company and beyond. And that lens and our 30-year history in the space has definitely given us some interesting perspective over the past, call it 6 months, and looking forward. I'd echo some of the comments that everyone's mentioned so far. Companies are being very prudent and have quickly readjusted to offset burn that they were carrying into 2022. But I think Pamela made an excellent point, and one that we're seeing quite a bit as well, that there's likely another shoe to drop within the next 6 months. Companies that have been operating in a terrific fundraising environment are generally pretty well capitalized right now, certainly within our portfolio. We're not seeing any really kind of material liquidity stress. And I think those conversations, like Michael mentioned, with existing investors are certainly helpful, given that sponsors seem willing and able to double down on their winners or find some ways to extend runway out to, call it 18, 24 months from now, rather than where they last raised. But I do think for some of those companies that maybe raised and really need to go back to the outside markets or external markets in early 2023, that's going to be a very telling process. I think it's going to take more time. I think you're going to see more pressure on valuations. We haven't seen that yet. But I also think the offset to that, we've been pleased to see that both sponsors and the operators at the portfolio companies have been quick to recalibrate to really the macro environment and the expectations associated with that.
What's interesting to all four of your comments, from an equity perspective, in 21, we saw $29 billion invested in our sector. This year, we're tracking to $20 billion, so off 30%, 30+%. But that'll still be the second most robust year, yet we're all anxious. So it's a little confounding right now. How are you orienting for new commitments that you're making? Do you think you'll be at or above where you were last year, maybe tracking below? Is the bar higher for new commitments? Maybe, Pamela, how are you thinking about new commitments and new relationships?
Yeah. So like you, Michael, a downturn's always the time that sometimes you get the best companies, right? So we're very excited and very active. What I will say is we are looking at runway of cash. So when I said the 12 to 18 months, that's really important, because you don't want to put debt in to a company that you're bridging to something that is unknown. So that is something, but we're seeing lots of great growth companies in great positions. And what usually happens is when, like you said, there's tons of money, but there's less money for some companies. When venture money is not there, companies tend to borrow more, but that's not a bad thing if they're good companies. And so that's the trend we're seeing. Just like in the beginning of COVID, you see a lot of crap in the beginning because people are trying to solve their problems with debt, but now we're seeing really good deals.
And anybody take this question. There are a lot of boards that we're on where our companies have at least 12 months of runway. And yet there's a nervousness where we're saying to the entrepreneurs, and there's several hundred entrepreneurs listening, so I want to be quite tactical. We think you should go explore venture debt to further extend the runway. Are those opportunities that are interesting to you, where we're adding on to already a pretty long runway for venture-backed companies?
Yes. Yeah.
And so how do you think about that? How are terms changing? Provide some counsel, Michael, to the entrepreneur who's sitting in that position.
Sure. It's pretty interesting what we're seeing. So there's, number one, a dynamic between a lot of the boards and the CEOs, where the CEOs want to load up on debt. They think that debt's going to solve their problem. So they have a lot of cash, but they, as you said, are feeling a little bit nervous. So they have, pick a number, 10 million in cash. It's going to last them 18 months. And they want $10 million of debt. And we're like, you might want to talk to your board about that. I don't think they're going to want to do that. And so then we have the discussion after the CEOs had the discussion with the board. He's, wow, you were right. They don't want me to borrow that amount. So that's number one. So we're seeing a lot of that. And once we get by that, the time to enter into conversations is at or closely after you raise that round of financing. For us right now, the only terms that have changed is because prime has increased. Our target IRR has just increased as prime has increased, but our terms have really not changed at all. We are...
Michael, what's the calculus of a company has 12 months of runway? How do you determine what's the right amount to take on at that point?
That's a good question. There's no cookie cutter approach. It really depends on how much cash they have. Is this a first time CEO? And is it a Series A? Is it a Series C? If it's a Series A, if you can believe it, it's actually a little bit easier. But more importantly, who are the investors? And are they brand new investors? Have they been through cycles before? Are they healthcare investors? Do they actually know the space really well? Are they people that we know really well and that we believe that we have a relationship with, that there's going to be good communication? So there's no cookie cutter approach, but that's the formula to do that. If there are investors in the syndicate that we do not know, then that's not going to be a deal that we're going to chase.
And Mara, how are you thinking about raising venture debt simply to extend runway? And it may not even get to break even.
Yeah, no, that's a very common, useful use for venture debt, right? It's to get companies to the next inflection point. And that's something that we do all day long. I don't think we're thinking about that differently. I think we're probably going a little bit deeper in our diligence as far as what's the likelihood of this company raising money right now, just because it's not as easy as it was, right? As it was from last year. We look at all the basics that we always have. I think an operator's ability to navigate through these choppy waters is really important, right? So we want that CEO that has probably been through a cycle or two before, and then just understanding what the existing investors are looking for the company to achieve in order to raise that next round of capital.
Yeah. And Brian, maybe take us into your investment committee meeting as you're looking at a new relationship. How are you thinking about the attributes or qualities of that credit? And would that have been different a year ago?
I wouldn't say they're any different from a year ago. I do think setting expectations with the CEOs or founders has changed a little bit. I always counsel them, given that we cover everything across the company maturity spectrum from seed through later stage, I counsel them and say, our underwriting shifts depending on where you are in that spectrum. If it's a pure kind of early stage deal, we're likely going to be looking more through your business model to the investors that are in the deal. I think the investor relationships between capital partners like you, Michael, and lenders is important at every stage, but certainly as the company grows, we can underwrite more towards the company business model as a standalone entity rather than saying, what does Flair necessarily think about this or any other sponsor? And certainly at the very later stages, it's more of a pure underwrite to the company. But the question underlying our underwriting doesn't change. It's, as Mara mentioned, what does the company need to do in order to raise external capital, assuming that's what they need and want to do? So whether that's achieving a commercial benchmark or a clinical one in some of the cases of the companies that we work with, we need to really diligence and understand what is the timeline to reach that benchmark. We as lenders want to align ourselves with the board or the equity expectations. We certainly don't need an equity outcome for our underwrite to work, but we want to make sure the parties at the table, the founders, the board, and the lenders are all aligned in terms of what's the expectation for success in the company. Understanding how those benchmarks fit into whatever cash runway you have is really the most important part of a credit discussion. And if there's, I would say, if that timing is tight, let's say you've got 12 months of runway and you're expecting your commercial benchmark or your clinical benchmark that's really going to unlock interest in that next round to occur around month 9, that frankly is probably going to be a more difficult conversation today than it was back in 2021, where you probably have more flexibility there given the strength of the equity market. That doesn't necessarily change where we shake out on terms. It probably changes the diligence that we'll do to make sure we're comfortable seeing the company through, or I guess ensuring that you as the sponsors and the companies themselves have a real tangible plan to get to that benchmark. But we're going to spend more time there. But in short, I think I would echo Michael's comments. We haven't seen terms of the debt side materially shift.
And what are you underwriting? Oh, sorry, Pamela, go ahead.
I was just going to say one thing I think I would add that we would all agree with is probably, if you're for the entrepreneurs, one of the dynamics that has really changed that we look hard at is what is the valuation? How high did this valuation get? And how hard is it going to be to get that on your next round, right? So are you going to be able to hit milestones that will get you to the valuation that you have today? And so that's become way more important for us. And the other thing I would say, who did your last round? Because if we had a Tiger or D1 or Coatue or SoftBank in there on the last round and they took a huge chunk of that company, how are you going to fill that hole? And so those are two things I think people in that position really do have to think about. And can you raise, or do you really have to extend that 12 to 18 months more to 24 to 36 months so that you can get to a level somebody wants to invest back into your company?
Yeah, Pamela, I want to press on that. And for all of you to comment, Mara said something quite profound, which is they're looking for experienced CEOs and entrepreneurs. We have a generation of people running companies or investors who've actually never seen a major correction. So how are you thinking about that dynamic? We have these brilliant younger investors and directors and CEOs who've never been through a correction.
Yeah, a part of, back to what I think we all had said, we're totally fine with very young founders who have never gone through this. But what's the makeup of the board? Are there quote unquote gray hairs around the table to help she or he, the founder CEO, to be successful? And so that's where, along with what Pamela said, valuation, that's where we're paying attention to.
So Michael, let me push on a little bit. It's 30 minutes that venture investors have, and maybe entrepreneurs. When we take on venture debt, we limit our degrees of freedom. And so is what you're saying, we actually want to exert more control and influence through covenants? Are there tweaks around the edges that would make somebody anxious about venture debt in this environment?
No, I'm sorry if I misspoke. No, we are not asking for anything different from the VCs. What we're looking for, not asking for, we're not asking for covenants. We're not asking for any handshake or guarantee. We're not asking for any of that. We want to enter into deals where we know that there are people around the table that we know and trust, that know what they're doing, that are on the block a little bit, versus having a founder CEO who's right out of school and very young, inexperienced VCs that don't have oversight from some of the better firms, without mentioning any names. That's what I'm talking about.
So, Michael, both Michaels. One point I would just follow up on there. I very much agree with Michael. Youth or inexperience as a founder or CEO, certainly not a red line that people as lenders aren't willing to cross. But I would go back to my comment about alignment between management and the board and aligning those expectations with us as lenders. For us, if that individual who's leading the company hasn't been through a downturn, that's fine. let's just make sure that we all together are comfortable with what direction is the CEO taking, what direction is the board giving, and frankly, we want to make sure that outlook is basically kind of all aligned, because I think dysfunction at that level is ultimately what's going to cause the problems with fundraising down the road when that discussion comes in 6, 9, or 12 months.
And I don't.
Go ahead, Mara. I'm getting the hook.
Okay, just real quick on that. I think alignment between the investors and the management teams is certainly important, but I think alignment with the whole syndicate is important, right? Because I think as it's going to be harder to raise new funds, you're going to get some unalignment between, do we support this company or do we not, among VC syndicates. So it's just something to be aware of.
My thanks to the 4 leading lenders in the space. We'll make sure the audience knows how to get in touch with you. We're big fans of everything you're doing for our companies. I'm going to turn over to my partner, Bill Geary, to take us through the next discussion.
Excellent. Michael, thank you. Really robust discussion. That was fantastic, super insightful. So now we're going to go a little bit further down the balance sheet. And I welcome TJ, Jim, and Rob to the stage. Rob, great to see you. Thank you for being with us. Jim, great to see you. Thank you. And TJ, terrific. Thanks for joining us. Now, we love all of our growth equity investor partners equally, but we really appreciate you 3 joining us today. So excited to jump in and pick up from where we left off in the last session. And feel free to give a quick intro of you, your firm, as you each answer your first question. We won't take up separate intro time, but so let's just dive right in. And TJ, let's start off with you. Where are we in terms of this current health tech and healthcare services market reset in growth stage investing?
Yeah, thanks, Bill. Thanks for having us. So I'm TJ Carella. I head healthcare investing at Warburg Pincus. Quick summary there. We're a 55-year-old leading global growth investor with about 85 billion of I'd say, unlike many of our larger cap PE peers, growth is core to everything we do. We're also willing to start a little earlier in terms of investment stage and then follow the company really through their life cycle. And we're often the primary capital provider. We've invested over 15 billion of equity in healthcare over 50 plus years. And we have a US portfolio of about 20 or so companies totaling approximately $10 billion of net asset value. And I'd say we also have a very flexible mandate. So we can be a minority investor, we can be a control investor, sometimes we do structured deals, et cetera. So coming back to your question, where are we? I think that's a question we're all asking ourselves in this reset. My suspicion is we're still in the very early innings. It feels private markets have yet to really change course in the same way that we've seen volatility in the public markets. It's also my experience that private markets usually lag somewhere between 6 and 12 months. I think often after you see somewhat violent dislocation events, there tends to be a disconnect between seller expectations and where buyers are willing to invest. I think the manifestation of that is significant slowdown in transaction volume. And I think we've certainly seen that over the last 6 months or so, where just the crazy frenetic pace of 2020, 2021 has slowed considerably, where we've been able to focus a lot more on growing our portfolio companies, looking at tuck-in acquisitions and thinking about how this next phase will play out and trying to get in front of potential opportunities, because we think this will be an opportunity, rich environment. I think what will change transaction volume is likely going to be a liquidity catalyst. And I'm sure we'll talk a bit about that, but the loss-making companies out there are going to need to shore up, if they haven't already, their balance sheets and really start thinking about what they need to do to get out ahead of liquidity issues. It could mean down rounds. It could mean, in some cases, financial distress. But fortunately, there's lots of dry powder on the sidelines in the healthcare, private equity, and growth category. And the highest quality businesses will no doubt find capital, in my view. And even fairly optimistic that valuations will be really supported for those best-in-class companies. It's really the other set of companies that are going to really need to get out ahead of some of these liquidity issues. So it's great. Really insightful. You just summarized, you characterized the entire VC industry by saying loss-making. So that's basically what we do on the earlier stage. Rob, over to you. Do you agree with that outlook? And again, a 2-second intro about you and General Atlantic.
Thanks, Bill. Hi, everybody. Rob, I lead healthcare investing at General Atlantic. GA, similar to Warburg in many ways, a global growth equity firm, 14 offices around the world. The firm's been around for 42 years. I've been with the firm for 19 years. To my friend Michael, who was on the panel before, I did brush in some gray hair in my beard this morning just to make sure that he feels like we're getting it right.
And you took the blazer off too, so you softened your image.
I'm softening it up. Anyway, GA invests around $7 to $8 billion a year. That's across all geographies and all sectors. As I mentioned, I lead our healthcare sector. Similar broad mandates, so we'll do company formation to Series B, minority investing to minority recaps to growth buyouts. Also similar focus where growth should be the primary driver of the returns for our portfolio. I agree with the comments that were shared around, we really haven't seen the degree of correction yet that I think is coming within the private markets. And even the best of the publicly traded companies have traded down 30, 40% at least from when they were valued at the end of last year. And of course, many others are significantly more challenged. We really haven't seen down rounds yet, at least to the opportunities that we've evaluated. I'd say the businesses that are burning cash the most aggressively and are in the weakest positions have at least signaled that they're open to doing down rounds. But I think those are very challenging situations where they're really just trying to find investors to bite and engage. So I do anticipate, unfortunately, we'll continue to see headcount reductions. I do agree that the capital need will be the catalyst for people to then seriously evaluate how important it is to maintain that prior valuation mark. And I think the watch out is, particularly in the last couple of years, it was almost like a sign of pride to say, look how quickly I raised incremental capital. Look at this up round that I got. And the temptation will be to go and try and find less knowledgeable, less qualified investors to try and maybe raise a smaller amount and still get that headline objective, which I think would be a mistake for entrepreneurs, and they should think differently about it. But we may get into that in a little bit.
No, that's great. Jim, over to you. What's your perspective? Are investors, growth equity investors, looking but not leaping, and what's holding them back? And again, start with an intro about you and Foresite Capital.
Sure. Thank you. So Foresite Capital is about $5 billion healthcare venture and venture growth focused fund. We, by the way, it says I'm muted. Can you guys hear me speaking?
Oh, we can hear you perfectly. Yep.
Okay, super. Great. Okay. I don't have a lot to add. I agree that this is very early innings. There is a lot of money that's on the sidelines, but money is very cautiously deploying. I can tell you, just like everybody else in this panel, we've been very cautious this year. We have a shopping list of companies that we think are best in class that for one reason or another, we missed out on over the last couple of years. And we're going after all of them that are doing well. And I do think that this is going to be a fantastic investing environment over the next couple of years. And frankly, last year was, I think, really crazy in a bunch of ways. We raised $14 billion for our portfolio companies. We've never had a year like that. And so it's not surprising that the pendulum's now swinging the other way. I think it's just begun to swing. Nothing much more to add than that.
Yeah, no. Are you similarly staying away from down rounds? There seems to be a reticence for a number of reasons. Is that how you'd describe it as well?
Yeah, at the end of the day, first and foremost, we're entrepreneurial centric. We certainly want to be going with directionally what great entrepreneurs are looking to do. And great entrepreneurs right now are waiting the market out, trying to understand what market is. And what we're seeing is things changing and people's expectation, even the most experienced and aggressive and successful, multi-time successful entrepreneurs are realistically evaluating what the options are right now. And then we're seeing people preemptively now starting to talk with us about deals that we think are like fantastic deals. And we're just closing one right now. They tend to be in the category of reopening up something where cards have been turned over, and it's a story that was developing to be exciting, it's become exciting. We haven't really seen the down rounds. And honestly, as I think about the growth side of the venture portfolio, not to say that we won't be involved in down rounds over the next couple of years, but generally speaking, we like entrepreneurs that are ahead of these types of things. And it's unusual. Maybe there's a person that happened to raise 2 or 3 years ago that's caught up in a little bit of this. But generally speaking, most of the top companies on our shopping list did take advantage of the environment over the last couple of years. And really the best that I think we can do is maybe get them to tuck in a little more cash now before more cards turn over next year.
Yeah, that's interesting. TJ, do you similarly think of entrepreneurs adjusted to the reality of valuation expectations and capital availability?
Look, I think it's happening. I think it depends on how you define entrepreneurs. We have a lot of CEOs who are a little reluctant to switch gears, and we're, as sponsors, encouraging them to think about this as a new reality and to do the appropriate amount of contingency planning to make sure we're able to pull levers on costs to the extent, we see top line pressure. These are businesses that tend to be cash generative businesses, or at least EBITDA positive businesses. On the flip side, when we're talking to entrepreneurs out there, I think there is an appreciation that the cost of capital has gone up. I think you can't go through the day without seeing a headline around what's going on with the Fed and interest rates and the flow through effect of that, not only in terms of macroeconomic stress, but also just the willingness of capital providers to enter into new investments has fundamentally changed. And so I think it's starting to set in. And I think the best entrepreneurs are those who move fastest and adopt to the new reality and try not to remember what 2021 was, but think about what their needs are. And oftentimes the first one is the one who solves those problems so they can get on the offense again. And as we've all said, this should be a target-rich opportunity set for entrepreneurs, for us as investors. But if we're backing companies, we want to get aggressive and consolidate during downturns. And there are opportunities that come out of it. And for the most proactive of the entrepreneurs out there, I think they'll be well positioned to take advantage.
Yeah, no, that makes sense. And Rob, are we still seeing tech investors swoop in to healthcare, or has their presence thinned out? And there's been a comment too about growth stage investors going earlier. Do you see the same thing? And how would you respond to that statement?
I think you've definitely seen less of that sort of crossing sectoral activity. And a lot of the tech investors also have very big public investing activities. And they've, I think, rightly been very focused, given the volatility in the public markets, on understanding their own portfolios there. But you've also just seen a lot less activity. And unclear to me is if that's because they haven't reset the marks on the private side and therefore they're over allocated there, or they're just more focused on the majority of their business, which is on the public investing side. But that competitive dynamic where it was certain firms would do a meeting, offer a term sheet that afternoon, very limited diligence thereafter. I haven't heard about one of those in months, which is a very healthy thing, I think, for the market. I think the activity is definitely diminished. To the second part of your question, Bill, I do think you're seeing, and I'm not sure if this is unique to the macro or indicative of the macro or unique to healthcare, but I do think you're seeing later stage investors that are going earlier. And it's not a general saying, hey, we want to get into the venture investing business. And I think most of those of us that are at the later stage growth side are really looking for businesses that have been proven. You've got established product market fit, you've got proven unit economics. But it is an environment, if you were counseling entrepreneurs, where it is highly uncertain. And it's unclear, is it going to get worse before it gets better? And access to capital, whether it's debt or equity, is far less certain than it was 6 or 9 months ago, all of which argues, I think, for partnering with scalable capital partners. And so the benefit to the entrepreneur is to get someone that's really going to stand behind and help you ride through that period of volatility and uncertainty. And the benefit to us is we can get in, again, if it meets those criteria from a proof of business model standpoint, get in at an earlier stage and then be a scalable capital partner and deploy capital over time as those businesses progress.
Yeah, no, that's great. Jim, we've got hundreds of people joining us for this webinar, many of whom are entrepreneurs. And so let's get pretty tactical as to the entrepreneur perspective. How should they be thinking about the critical milestones, the proof points? What metrics do they need to deliver in order to raise their next financing round?
Firstly, I break it into early venture and late venture. And then I break it into pre-revenue and post-revenue, pre-revenue being on the biotech side. So as it relates to early venture, I think across the boards, we would be looking to do much larger rounds, very much building on what Rob was saying, getting enough legs around the table to supply capital to get us out of this cycle. And the cycle, as I think we all have said, it's really feels to us like it's early. Could be 23, 24, even 25 for certain aspects of the business. So we're just taking ourselves in the early stages of things, a conservative point of view regarding dilution and making sure that there's tons of cash around the table. The flip side of it is we also think that science and technology have really been coming together in an unprecedented way, and that the opportunity set for startups that are launching now are some really fantastic startups. So we want to make sure that they're very well capitalized. And then on the later stage side, I think it's the same theme with the exception that companies do go through periods of time where they open up or change the type of investor that comes into them. And so we might be a little bit sharper with regards to that, also much more open to debt as partners in these. and also very open to larger pockets as partners.
That's great.
Limited partners.
We've got 2 minutes left, so one rapid fire question for each of you. What's one piece of advice that you'd give health tech entrepreneurs looking to raise capital now? Rob, let's start with you.
Highly uncertain environment. Make sure you have more runway than you think, to the point that was just made around it's very hard to predict how long this is going to last. And it is not a time to try to optimize headline value. It's a time to get the right partners around the table to help you navigate that environment.
TJ, over to you.
Yeah, that was a good one. I would double click on something that was said earlier, which is unit economics. Like the companies, and I know a lot of the audience are earlier stage companies, the companies that have well-defined unit economics are the ones, even if they're losing money or cash burning, they're the ones that will definitely get financed. And so just focus on that, make sure it's a really compelling and clear unit economic case.
Jim, any one piece of advice you'd want to add?
Keep your sense of humor.
In these difficult times, that's super important.
Yeah.
Listen, thanks so much, Jim, Rob, TJ. We really appreciate it. Obviously appreciate the opportunity to co-invest and partner with you and doing more of that going forward. So thanks for being with us this afternoon. And now as we welcome our group of entrepreneurs to the stage and my partner, Ian, who will moderate that session. Ian, I'll turn it over to you. Thanks again.
Thanks so much, Bill. Thanks, Jim, TJ, and Rob for the amazing sessions. So let me welcome Ankit, Kuldeep, and Steve to the stage. And as what we did just now, like maybe for each of you, I will start off with a handful of questions and then ask you to say a few words about your background and the company you represent. But maybe let me start with Kuldeep, given that one of your investors just spoke. Could you share with us what the fundraising process was like in the past year? And are there things that investors ask you that you haven't experienced before?
Thanks, Ian. I'm Kuldeep, founder CEO of Bioformis. We are a technology company really focusing on delivering the right care to the right patients in the comfort of patients' home. We have built a platform along with our care delivery services to manage patients throughout the continuum of care, which includes acute, post-acute, and long-term complex chronic conditions. We raised our Series D financing just May of this year. We raised a $320 million, which was led by General Atlantic. And certainly as over the past few years, we started the company in 2015. And since then, we have been very focused on building the product, going through clinical validation, regulatory approvals, testing our go-to-market strategy, having that initial traction, and proving out our models. But I think as we think about or thought about our Series D, it was extremely important for us to bring in investors who understand this space extremely well, especially when it comes to scaling within health system, within payers, risk bearers, et cetera. And certainly privileged to have General Atlantic, CVS participate in our financing round. So as we went through the diligence process, it was very thorough and multiple things which were looked at. Everything from customer validation, specifically, does the product work? What impact have we shown? Both clinical outcomes, economic benefits. Is the product and technology differentiated enough in the marketplace? What is the total market opportunity? And going deep into understanding what are some of the patient population cohorts we are going to target and how big can this get? Looking at unit economics, the margins, the pricing model, deep dive into the pipeline, not just superficial, but very much detailed overview of what the next 12, 24 months are going to look like from a top line as well as bottom line. And finally, it was, do we have the right infrastructure and the team to be able to get us there?
That's great. Thank you, Kuldeep. And we'll definitely circle back on a number of the points. Maybe let me shift gear to Ankit and welcome you to the stage. And then really to many of us, like observing the market, of course, been tracking you for a while. We're a little surprised to see you raise another big round, like shortly after the prior round. Can you walk us through some of the thought process behind it? And maybe can you also comment on whether or not you consider venture debt? We also noticed you have strategics on your cap table. Can you walk us through some of the thought process?
Yeah, thanks, Ian. I'm Ankit. I'm the founder of Bicycle Health. We provide treatment for opioid use disorder over telemedicine, and we're the largest provider in this space. It's a tech-enabled services business. We have a medical group where we full-time employ a multidisciplinary clinician team, but also build the technology, the go-to-market, the patient acquisition engine, and things like that to provide our care at a high quality in a scalable way. And so, yeah, we're national. We're in 28 states. We're serving thousands of patients and growing quite quickly as well. Ian, you referred to our Series B, which happened, I think, less than a year after our Series A. So our Series B was a 50 million round. And I was quite surprised as well that it happened so quickly. It was a weird market. Q4 of 2021, where I think it was at the peak, is when two of our competitors raised massive rounds. And so we started getting a ton of inbound interest. And that was only 6 months after we had closed our Series A. And so we started entertaining those without any real need for capital. And then Q1 is when the market started going down. And so we had to take a call on whether we should raise now. I think when we ended up raising the Series B, we still had about half of our Series A in the bank. But we had to take a call whether we ended up raising now or raise later, but suffer the market getting worse. I think we ended up taking a good call, mainly because I think we had the luxury of money in the bank. So we were able to find the right partner to go with and the right deal to go with. And so we ended up finding the right partner. We ended up having the partner give us a deal that was extremely clean. And we also ended up raising the right amount of money at the right valuation. So all of the sort of ducks were lined up. So there was really no reason to not raise and de-risk ourselves against the market. So we're now in a place where we have 2.5 to 3 years of runway and are able to accelerate quite well.
Thank you.
And coming back to venture debt, yes, we did sign a term sheet for venture debt and are in the process of closing it. Because again, I think because we raised our Series B and started the venture debt conversations right away, and we have pretty good unit economics and a good investor cohort across the board, I think we got some favorable terms. And so again, there was really no reason to not have that security, especially because we could also use it in hard assets or acquisitions or other things where we could actually, it doesn't have to be just a runway expansion tool. It can actually be a pretty sort of strategic capital base that you can deploy in a specific way. So there was no reason to not raise that if the terms were good, which they were.
That's great. And Ankit, maybe just quickly, one word you mentioned, you used the word clean terms, and maybe for you to share with some of our audience, like on the stack of the various things you are evaluating, how important is having a term sheet that's clean term?
Oh, absolutely important. Literally, our Series B term sheet is our Series A term sheet with just the expansion of the board and some basic stuff. But I went into it with the assumption that the market is going to go worse, which I think might actually happen. And so when the market is terrible, I would like our investors to be aligned. I would like them to be mission driven. I would also like them to actually work together to help the company get better versus work against each other because of some of the incentives that have been layered on across different rounds. And so having clean terms is actually more important in a bad market to help the company be saved and continue to operate well versus in a good market. So I optimized for the right investor, but because I had money in the bank, I could also optimize for having a clean term sheet.
That's great, Ankit. And maybe let me move to Steve and a couple of the points Ankit mentioned. Steve, you lived through quite a bit of that and also moving to the next phase of 30 Madison's life cycle. Could you maybe share with us some of what you have experienced? I'm sure many of the investors approach you guys over the last few years, trying to encourage you to go out fundraise. Like, what are some of the thought process you went through in the last year?
Yeah, absolutely. Thanks, Ian. And I'm Steve Goodentag. I'm co-founder and CEO of 30 Madison. We're the largest virtual specialty care company in the US, and we've built a company that delivers specialty care for patients with chronic conditions, ranging from the lighter side of healthcare with men's hair loss to much more complicated issues like migraine, atopic dermatitis, behavioral health, and others. We took advantage of 2021 financing market, and part of the calculus was I think something similar to what Ankit shared, which is it's always best to raise when you're in a position of choosing to raise versus needing to raise. And when we thought about the calculus of the right amount and who the right partners were and when was the right time, it really came down to understanding really clearly what was the additional capital going to provide. At the time, it was focused more on scale, faster growth, or being able to double down in some of those investments. I think today, having the additional runway and the additional capital on the balance sheet is certainly a valuable byproduct of that. And then for us, when we raised, we were fortunate enough to be a bit oversubscribed. And so we also thought about the right amount last year and ended up taking on a bit more than we initially had done. And I think it's actually something that we've done historically at different points in time. And you always balance how much dilution am I taking at any given round. And every time I've looked back, I've always said, I'm glad I took a little bit more than I initially went out to if I had the opportunity. And I say that probably 10 more times after last year as well.
That's great. And Stephen, maybe one observation we have also made recently is that when there are a lot of companies trying to preserve capital, you guys went out of the way and even make some strategic M&A, right, as being one. Can you walk us through what's the thought process behind deploying capital when many of your peers are preserving capital?
Yeah, and we are definitely thinking about making sure that we are preserving capital in a thoughtful manner, but also, especially in a time of turbulence, scale can be really important. I think scale in healthcare matters a lot, but especially in times of turbulence. And so when we were looking at the Nurex business, we thought about one, what would allow us to build a healthier foundation, a healthier business very quickly. And also what allowed us to leapfrog in terms of being a consolidator in this market and making sure if we get the right foundation early in what appears to be a much longer turbulent cycle, and we can bolster that foundation, it's going to create opportunities in the next few years to add on to that. But we got to get the foundation right. And so for us, when we looked at Nurex specifically, it was a really unique and exciting opportunity because one, it allowed us to massively increase patient scale and revenue of the business. We effectively doubled our patient count. We had very little overlap there. And that's we see as a really valuable opportunity because now we can reach patients with additional service areas. We have additional brand recognition that makes it easier for us in the coming years. Bit of diversification as well in terms of increasing the number of conditions that we could serve quickly, but also where our revenue streams come from. Historically, a significant portion of our businesses had been in the direct-to-consumer space and patients paying us directly. With our Nurex edition, as well as our push to diversify beyond D2C, it effectively instantly gave us a massive base where now a significant portion of our business comes from enterprise in addition to D2C. And I think in having that diversification of revenue at this time is also quite valuable for us.
That's great. Thank you so much for the insight. And maybe let me ask Kuldeep a similar question. Given that the massive amount of capital you raised recently, is M&A on the horizon? Are you actively looking to acquire companies, or that's something not something you will be focusing on?
Yeah, that's a great question, Ian. Certainly, as we think about capital allocation, the first focus is fund our organic growth plan, right? Certainly, we have a strong organic growth plan with penetration planned more into health systems and biopharma, which is what we have been doing over the past few years. But as we think about the market, there's a lot of consolidation happening. Certainly, there are companies which potentially could give us quicker scale and penetration. So the kind of companies we certainly are looking for, is companies who can give us patient volume, customer penetration, increase in revenue, addition of new specialty areas, and eventually the companies that can potentially take us more faster into value-based contracting. So those are the kind of companies we specifically are looking at as potential M&A targets.
Great, Kuldeep. I know we're coming up on time, so maybe I'll also ask you each to give a rapid fire answer to maybe provide one piece of advice to entrepreneurs looking to fundraise in the next 6 to 12 months. I'll start with Steve.
I think the bar is certainly higher than it's been, and that means it's going to take longer. So plan for that. Plan for additional time, additional diligence, getting to know. And I think especially, this is generally good advice, but especially over the next 6 to 12 months, it's going to be true, which is optimizing for the investor and partner around the table more than just the valuation. You want someone who's going to work with you and go to bat for you during turbulent times, more so than just someone who's writing the highest valuation.
Thank you, Steve. I see you, Ankit, nodding. So maybe for you to give one piece of advice.
Yeah, I think just pulling that thread, raise when you have money in the bank. So the sooner the better, or sort of plan for longer timelines. But also, if you need to take a revenue hit, but you have to work a lot more on your unit economics, that's a good trade-off. So that might naturally decrease the valuation you might get, but I think it would increase the chance of successfully raising the round. So really focus hard on your unit economics and all the puzzle pieces that go around it, get that to a good place, and then raise earlier rather than later.
That's great. And Kuldeep, one word of advice or one sentence?
Yeah, specifically, I see a lot of companies trying to fundraise, especially in healthcare, doing many things. I would strongly recommend doing one thing, focus on certain key metrics, what you want to potentially demonstrate to investors, because they are going to go deep and you need to have the right matrix and historically showing the growth. And that's going to be extremely critical.
Great. Thank you so much. I know we're coming to an end. As we close the session today, we just want to thank all of our guests for their time and insights. We cover a lot of grounds. Obviously, there's a lot more to talk about here. So as always, please reach out if you would like to continue the conversation. Thank you once again for joining, and we look forward to seeing you for our next expert roundtable.
Thanks a lot.